Welcome to today's Explainer. We're putting on our lead financial analyst hats today to present a rigorous Warren Buffett-style investment thesis on Cavco Industries to our Value Investment Committee. We are going to look strictly at the data from the company's SEC filings to answer one main question. Is this a wonderful business trading at a truly fair price?
Okay, here's our game plan. We'll walk sequentially through the business fundamentals, deep financials, our valuation models, the all-important margin of safety, and finally, our verdict. Let's just dive right in.
Section 1. Business and Economic Moat. Let's see if Cavco actually fits the bill of a wonderful company. So in a nutshell, Cavco is a leading builder of factory-made homes. They are out there actively solving America's absolute massive 5 million unit housing shortage. And they do this through a highly vertically integrated model. They combine modular home manufacturing across more than 30 facilities with direct retail distribution and financial services. By integrating the manufacturing with lending and insurance, doing the whole shebang, they're capturing margins at multiple steps of the customer's home buying journey. Now, this is where it gets really interesting. Cavco has a 14.5% market share, and that vertical integration establishes a solid, but definitively narrow economic moat. They have a huge lead over smaller regional builders, and their scale absolutely gives them a cost advantage. But we really can't call this a wide moat. Why? Because they still trail heavily behind the industry giant Berkshire Hathaway's Clayton Homes, which eats up a whopping 45% of the market. Plus, there are intense bidding wars for retail locations, like a recent $45 million acquisition Cavco made, which proves the battle for distribution out there is fierce. So, how does it fare against the legendary qualitative Buffett checklist? Actually, really well. Is it an understandable business? Yes, they build and finance affordable housing. Do they have a durable competitive advantage? Yes, their scale and proprietary tech give them a real edge. Do they have consistently high returns? Absolutely. Their trailing 12-month return on equity is a robust 17%. And finally, is management able and honest? The filings suggest a resounding yes, which leads us right into how they allocate capital. Speaking of management, they've proven incredibly shareholder-friendly. Over the past 2 years, they've actively shrunk the share count, committing $291 million to repurchases. And get this, at the exact same time, they've maintained a pristine balance sheet. We're talking $242 million in cash and absolutely zero corporate debt. I mean, zero debt in a highly cyclical industry? That is exactly the kind of discipline a value investor wants to see. Moving on to Section 2, Deep Financial Statement Analysis. Time to look under the hood and see if the numbers back up the story. Despite their trailing 12-month revenue hitting an impressive $2.2 billion, we're seeing a classic margin squeeze right now. Look closely at these Q3 2026 numbers compared to the prior year. Top-line revenue actually grew by a very healthy 11.3%. However, gross margins contracted from 24.9% down to 23.4%. Because of those higher costs per unit, net income literally fell by 22%. So top-line growth is completely overshadowed by bottom-line contraction right now. But if we zoom out from that recent quarter, the underlying engine of this business is still super strong. A crucial Buffett metric is return on invested capital, and Cavco stands exceptionally strong at 18.87%. That tells us they are highly efficient at taking cash and turning it into profit. And return on equity? It's sitting at a really healthy 17%. For a manufacturing business carrying zero long-term corporate debt, generating a 17% ROE easily clears the hurdle rate most value investors demand. So here's the million-dollar question. What are the true owner earnings for Cavco? Warren Buffett relies on this metric to strip away all the accounting noise, giving us a much truer picture of the free cash flow than just looking at net income alone. Let's calculate it straight from their GAAP reconciliation tables. We start with a trailing 12-month net income of $184.4 million. Then, we add back the non-cash depreciation and amortization, which is $21.6 million. Finally, we need to subtract maintenance capital expenditures. Now, the filings don't explicitly split out growth versus maintenance CapEx, so we're going to play it safe. We'll conservatively subtract their entire total capital expenditure of $33.5 million. That leaves us with a very robust $172.5 million in true owner earnings. We do have to talk about the red flags, though, because no company is perfect. We've seen a real loss of operating leverage recently. SG&A expenses rose to 14% of revenue, up from 12.6%.
Combine that with an estimated 6% spike in material cost inflation, and Q3 earnings completely miss consensus estimates. This exact margin squeeze is what triggered the recent market capitulation in the stock. All right, Section 3, Triangulating Valuation Models. Let's attack Cavco's current stock price of roughly $484.54 from multiple angles to figure out what it's actually worth. Our main workhorse here is the discounted cash flow, or DCF model. We take the company's historical earnings growth of 9.5% and blend it with a forecasted growth of 8.06% to project out free cash flows. Then we apply a terminal perpetual growth rate of 2.5% to roughly match long-term GDP. Discounting all that back to present value gives us a fair value of $793.72 per share. That suggests the stock is heavily undervalued at $484. And just a quick note, we're skipping the dividend discount model entirely here. Since Cavco doesn't pay a dividend, they prefer buybacks. Now, I want to be totally upfront about our assumptions here. Because the SEC filings don't explicitly hand us a weighted average cost of capital, we assume a standard 9% discount rate based on the risk-free rate plus an equity risk premium. Also, when we run the classic Benjamin Graham formula in a minute, we're assuming a current AAA corporate bond yield of 5.5%, since that data point is also outside the company's reports. But wait, looking at multiples tells a totally different story than our DCF. Cavco is trading at a steep 19.7 times earnings. If you look at its peers and U.S. consumer durables, they're hovering between 11 and 11.7 times earnings. So the market is assigning a massive premium to Cavco's operational excellence, meaning on a relative basis, the stock actually looks kind of expensive. If we flip it and run a reverse DCF, we ask, what growth rate is the market actually pricing in at that current $484 price tag? Given the huge gap between the market price and our $794 intrinsic value estimate, the current price implies a growth rate way lower than management's 8% forecast. The market is clearly pricing in extreme pessimism regarding those margin squeezes we talked about. Section 4, Margin of Safety. Let's figure out our downside protection before making any final calls. Look at this massive spread in our valuation triangulations. The Graham intrinsic value calculation comes in much lower, at roughly $458 per share, while our DCF model is super optimistic at $794. And where is the current stock price sitting? Right around $485, dangerously close to that lower Graham baseline. If we apply a strict 30% margin of safety just to our optimistic DCF value, we'd get a target buy price of $555. But honestly, because our multiples comparison and the Graham formula suggest the stock might be fully priced or even a bit overvalued right now, demanding an even steeper discount is definitely the prudent move for us. Which brings us to Section 5, our final Buffett-style verdict. Is this a wonderful business at a fair price? Let's finalize it for the committee. The verdict? It's a firm hold. The business fundamentals, zero debt, fantastic return on invested capital, and a massive structural housing tailwind are absolutely wonderful. But the recent margin contraction from inflation, combined with that 19.7 times PE premium against its peers, means we just don't have a perfectly fair price yet. We need to be patient before deploying our capital. I'll leave the committee with this final thesis summary. Cavco is a superb operator in a vital sector. But remember, as value investors, price is what you pay and value is what you get. So I ask you, does the market's current fear of margin compression present a rare opportunity, or is it a justified warning? For now, we sit on our hands, remaining patient and watching for that perfect strike zone around $438 to firmly secure our margin of safety. Thanks for joining this explainer and keep your eyes on the data.